Welcome back to the Capital Mindset Show, everyone. Hope you guys are having a great day as always. Today we're going to be talking about SoFi stock. They just recently reported on Monday, and we're going to be kind of giving a quasi update. We already updated the community, and I think it's fair we update you guys here on YouTube as well via a video. So here's the video. And here we have SoFi actually rallying 54%. Congratulations if you bought it at the lows, by the way, as well as the broader market rally. I mean, my goodness, the portfolio is up an astronomical amount. So I think SoFi's kind of benefited from bad expectations and then turning into maybe a little bit more rosy expectations, followed by broader market rally. So you've done pretty well there. Now let's talk about the earnings per se, because lastly, I left with you guys the following kind of thoughts. And I believe that SoFi has a bad bank attached to two interesting products, the technology platforms. But I find a lot of technology platforms interesting. That doesn't mean I'd invest in them. I feel like the applications are interesting. What they're solving is interesting. Do I think that they have a monopoly on it? No, by no means at all. But it's the more interesting components of the business. And I feel like some investors, for example, maybe you are this yourself. If you are a SoFi investor, you're investing solely for the technology. Or maybe you're the other kind of investor that's truly investing in it for the banking side. So let's get right into the presentation. I feel like the presentation will do a decent enough job at kind of navigating the narrative here. So I want you to show you first the product growth and compare that to the membership growth. The membership growth being 51% year over year, with the product growth being 53% year over year. We're going to applaud them for that. So on top of that, I want to show you this timeline. Also kind of give them some credit where credit is due. They've been developing some interesting products, kind of building out an actual bank offering. So part of the broader thesis with SoFi is that they cater to a higher income let's say group, right? And I think the average income for their products are well in excess of 100,000, and they claim or boast to claim that they have a credit rating in excess of 740 on average. So that's very good. I actually tested out their product myself for the purpose of this video. Well, not for the purpose of this video. In truth, it's because I am shopping around for different deals, and I don't think they're going to be able to offer me a better rate from what I've seen than my current banks, because I have very good relationships with them. But it was very interesting to see how rapid they were in their response time to kind of get on the phone with me and really try to sell me on a mortgage through them. So the primary loans that they have at this bank, you need to know, are student loans and personal loans. These are, without, sugarcoating it, these are the more degenerate side of the risk curve in terms of loans. And that's very important for something we're going to talk about later. Again, my personal opinion, I don't like the bank. I find the technology interesting, but that's about it. Now, going down to some other stuff, they have Galileo accounts. This is the technology platform. You can see the growth rate actually start to slow down. So remember, my opinion is that this is the actual interesting side of the business. Now, some of the parts that is a bit concerning, sometimes when you are trying to offer your products to your competitors, they might not be as willing to take your product. Now, their product solutions do have some implications for non-bank entities. That is true as well. So they do have some room to grow in that area. I kind of put a question mark on competing against your same customers. Your product has to be insanely good in order for your customer to kind of ignore that. And that's kind of yet to be seen. I don't want to jump the gun on that. So, but Galileo accounts are actually slowing down their growth. They're still growing, but it's slowing down. And projections for SoFi are that sales are going to decrease in the next quarter, and then followed by subsequent growth rates in the following quarters after that. It's kind of ending the year strong. Now, keep in mind that SoFi as a bank is kind of in agreement with the larger banks. I covered the larger banks also in the community. I probably should do an update. Let me know if you want me to do a broader banking update, because it's really rather interesting how all the banks have changed their tune. And we followed Wells Fargo a lot last year and kind of followed around their, let's say, guidance. But things have really changed for some banks. For some banks, no, but for some banks, yes. So for SoFi, they're kind of all in alignment that the Fed's going to raise 2 more times, then subsequent cuts. But that's kind of where the market's at. That kind of prices in soft landing. So in a soft landing scenario, that's actually going to be quite favorable for something like SoFi, where their degenerate side of the risk curve isn't going to do as bad. But we're going to get to that in just a second. So lending and financial services products, I can tell you right now, the growth rate here looks impressive, but when you consider that the side that they're taking on, again, the degenerate side of the risk curve, we can call it whatever we want, but that's basically what it is. It's easier to grow in that space. It's easier to originate loans that other financial institutions are less willing to do. So the bigger banks, they don't really focus on this, and there's a reason why. Okay, maybe they have the edge. Maybe they're fantastic at originating these loans, and they're going to have a crazy low delinquency rate. That could be the case, but you have to be very confident in that. So one thing that I guess I would kind of do is people are kind of evaluating this business on an EBITDA basis, which is rather, trying to be nice, rather silly. Now, the book valuation method for this is you're getting in the right direction, but it's very difficult to really justify that because price to book for a bank is a very good, I guess, surface level analysis, right? But there's way more to it than that. You don't just stop at price to book. I wish it was that easy. I wish you would say, oh, below price to book, bank, therefore buy, or below price to book, insurance, therefore buy. I wish it was that easy, but it's not. And you want to use price to book alongside other metrics, just as an example, right? Because it goes a little bit deeper than this, but as an example for a beginner, you can use price to book and do a cross analysis with return on equity. And the higher the return on equity the business returns, the greater the premium to book. Now, other qualitative analysis should be done on the book. For example, like we need to find out what is the quality of this book. What's in there? Is it credit card loans, mortgages, treasuries, what's in there, okay? And different types of books should be given different premiums. Remember that we do also have to consider with banking institutions counterparty risk. We talked about that with Citigroup. Why does Citigroup always trade at a discount? Refer back to the older banking videos where I do go over that kind of stuff. So overall, it looks like high growth, etc. So that's where I'm going to take you guys over to the results. So if you go over here to their recent results, published results, and we can see there the 3 months ending December 31st. I take you down to the line item, provision for credit losses at $14.945 million. Now, if you look back at the year ended for the, I think that's the full year, you can see it was 54, but still, when you kind of map it out against their loans, it's very, very not a conservative, aggressive. So it's quite aggressive estimates as to how many of their loans will go delinquent. Now, it could be correct. It could be correct. But I really highly suspect that they're not going to be nearly as good as JP Morgan Chase or American Express. This implies that they're going to achieve such a level or getting close to that level. So would I be willing to take on that bet? Investing for the bank side? Probably not. Okay. And I kind of almost, it brings a lot of questions more than answers looking at that, really. And they do classify the vast majority of their loans as available for sale. So that does actually change some of the implications of how they can account for it, et cetera. But for the most part, we're taking a look at how they're treating it, how they're planning out for what's to come. They're pretty much saying, we are extremely confident in our underwriting capabilities. And even though we're on, again, I'm going to say it, the degenerate side of the risk curve, they believe they're going to have very few delinquencies. That could happen. I'm just personally not willing to take that bet. Okay. So what are the bullish narratives that you got going on for this company? Let's talk about that. Well, you got the technology platform, you got momentum, it is heavily shorted. Maybe you get a short squeeze. I don't know. But really what you're really focusing on is getting that soft landing. If you get that soft landing, this company could actually do well if they are guiding for profitability in the later half of the year. I think it's Q4 2023. So if they achieve that, and that's GAAP net income profitability, that's going to be great. If you actually take a look at some of the stock-based compensation, it has actually been coming down. So that's good there for you guys worried about that. But really, if you're thinking anything other than soft landing, there's a lot of question marks to be had here. While the most recent rally is, of course, very enthusiastic. Keep in mind, when we've been talking about this company, the longer term picture is still quite abysmal. Since its IPO, it's been pretty much dead money, if not just down. Now, that's maybe you might blame Chamath for that, for overhyping it to retail investors. And at the end of the day, this is a very crowded retail stock. Okay. At the end of the day, this is very crowded retail stock. Now, some of the fund managers that are in this are a lot of the ones that kind of, you could say, move into that direction where they like to say the buzzwords, innovation, technology, automation, AI. Those guys are pretty much going to be involved in this. So with all that kind of coming together, what are my thoughts on the overall business? Well, if I were to be involved in this business, I would need a heavy discount on price to book, just more or less in line with the many other lenders within their kind of category, focusing again on private loans, etc. So oftentimes that can entail a price to book of about 0.5. Right now, they're not really showing there's not a lot of history to go off of. So I would need a decent margin of safety for me to even consider this. Now, if they had a proven track record, an absolutely proven track record through multiple cycles, that their underwriting capabilities are that of, American Express, then I would probably be more willing to take a bit more of a premium on a company like this. Again, if I'd be watching this company, it's mainly for the technology platform solutions and what those are doing, if they're really growing, living up to their potential, or they're overhyped, okay? Because that could also be the case. I believe that there are a lot of fantastic opportunities in the market. I've actually taken on, I've been saying in the portfolio updates, by the way, that I'm done with my core holdings. I'm very content with the performance thus far, but there was a new addition to the portfolio, which I will not be telling you in this video. That will be in another video that we're releasing sometime. So with that being said, thank you guys so much for watching. If you guys enjoyed this video, feel free to leave a like, or let me know down in the comment section below, are you buying SoFi, avoiding SoFi, and why? And we can start the conversation there. Otherwise, I'll see you guys on the next one. Bye.